Okay, hello, my name is David Andolfatto. I'm with the Federal Reserve Bank of St. Louis, and we're here at the 39th Annual Fall Conference. I'm here this morning with Fernando Alvarez of the University of Chicago, and he's kindly agreed to take some time to tell us a little bit about the paper he's going to present today, called Mandatory Disclosure and Financial Contagion.
That's right.
Thank you for being here, Fernando. Why don't we begin with just, why don't you tell us a little bit about the question that you're addressing in the paper?
Okay, so the general question actually is to study one of the aspects of the stress test. The stress tests are one of the sort of policy tools now used both by central banks, mainly the ECB and the Federal Reserve, to, the stress tests are sort of complex, but one of the things that they do is they analyze how the banks will fare in different scenarios, and then they make this information public. They also stress test have other aspects to it, but in our paper, we mostly analyze that feature.
So these stress tests, this is something new, or is this something that's been done in history? Is it something that's come about because of the financial crisis?
So the form of the stress test has changed a little bit, more than a little bit, because of the financial crisis. But obviously, there will always be supervision from central banks to commercial banks and other sort of banking institutions. But there has been a sort of a change to make the information public, for instance, which is not something that you have seen before, and precisely that's the aspect that we try to study.
I see. So regulatory bodies have regularly kind of stress test banks before to kind of see how resilient they might be under different alternative financial stress conditions. But what's new, you're saying here, is that they're making the information public to the community. And you're interested in the question of whether this is a good idea.
Exactly.
Or
so
not.
Under what conditions this is a good idea from a sort of public policy perspective?
Okay.
Precisely because, as you mentioned with your question, this is new. It happened in the financial crisis, and you see both in the academia, in the policy-making circles, like some Bernanke's speeches, and obviously his influence during his tenure on conducting the stress test, but also in evaluating it after in the ECB. So you see it in the public policy arena, in the academia, and also in some of the practitioners. Sort of they kind of thought about some of the advantages, but we want to think about if they're so good, why banks don't do it by themselves. If something is so good, because the idea is not that they are doing something to, get banks doing something bad. Right. It's just that they're doing something that, in fact, it will even help banks. It will help everybody.
Right.
So from that perspective, we want to think about why if they're so good, why they don't do it banks themselves, and also if they're so good now, is it like some discovery that now they are good and before people didn't realize, or is because of the financial crisis that this is special circumstances where they are good or not? So then our paper sort of take a bit of like most academic papers, a stylized version of the world, and try to answer these questions in that stylized version.
So there's also reasons for why. I mean, why this type of information is not disclosed publicly.
Correct.
There's conventional reasons for perhaps the stigma that such a disclosure might impinge on a particular bank that's identified as being weak. So what do you have to say about that? I mean,
So the conditions that what we try to find out is we study a setup where sometimes is this sounds very wishy-washy, but sometimes it's a good idea and sometimes it's a bad idea
to
conduct to conduct. But we kind of get a bit more precise. Okay. So the times in which it's a good idea is when there's a lot of contagion, in the sense that the fate of a particular bank is not determined that much by how these banks operate, but by how the whole network of banks operate. Something that had been noticed, for instance, during the crisis, that you had like a market freeze, because not so much that I know that there's a large loss, but maybe there are losses that are not huge, but they are there, but I don't know where they are. So the image that we have is there are some bad apples, but we don't know where the bad apples are.
I see. So the location of the risk is not known, and this potentially poisons the whole barrel.
Exactly.
People just want to stay away from the unfairly penalized
Well, everybody. So everybody
Right.
doesn't trust everybody else, and then these are situations where the interesting aspect is these are situations in which individual banks may not want to themselves show that they don't have the bad apples, but if they're all encouraged to do it, then you could get in a situation that is better for everybody and freeze the markets.
So, okay, I'll have a couple of questions here. One is, I guess then, under these conditions, we should observe that individual banks express voluntary desire to participate in the program.
So if you know that the other banks do it,
Yes.
you are fine to do it.
Right.
But the whole idea is that this question of why they don't do it by themselves is that if you're the only one, you may not want to do it. And I think the intuition we think is relatively simple, which is that when I actually disclose, and let's say that this has some cost, among other, let's say it has some cost to disclose this information, I have some benefit that I show that I'm, to potential investors in the bank or the other creditors that
You've survived the
that
stress
survived the stress test. But I had some costs and I had some benefits. But this also benefits you, say you're another bank, because I may owe you some money to you, and now you know that you're solvent.
Right.
But obviously I don't take this into account.
Right.
Well, obviously. Most of the time I wouldn't really have any reasons to particularly
Not as much
weigh.
as you should,
yeah,
probably.
exactly.
Right.
And then the idea is that if you are all forced to do it, then
Collectively.
the social cost, the social benefits will be internalized.
Sure.
Now, in a situation in which we don't trade that much, so we'll not have these interlocked portfolios, so that your fate is so much dependent on mine, then this wouldn't be an issue.
I see.
So like in normal circumstances where there's not much what we call contagion, then this stress test may not be, the private and social benefits will be aligned.
I see. Is it possible then, so your paper makes a very clear when and when not this,
Right.
this type of policy of mandatory disclosure of stress test results is a good idea socially. And you mentioned that it all hinges on the degree of what you call potential contagion,
Yes.
the extent to which banks are interlocked
Right.
in like owning, I guess, assets, claims against
It's the
each
idea
other.
that maybe Lehman didn't have anything bad themselves, but then someone else owns money to Lehman, and because of that, I don't want to lend to Lehman.
But my question would be kind of operationally. I mean, how the policymakers, can we observe this interlocking set of claims? I mean, this is something we can see.
Yeah, so that's the idea is that you kind of want to fall precisely the idea, not sort of for policymakers but for investors, is that if a lot of people disclose information, you could try to find the architecture of the financial network and really see where the bad apples lies. Now, obviously, you'll always be imperfect, but the idea is that one person, only one bank, disclosing information will give very little information about the whole network, while a lot of banks disclosing information will help a lot.
I see.
So it will be imperfect, but there is always, in fact, if you think about clearing houses and this type of financial arrangements, they're all about like, I'm trading with you, but do I have to worry about your trading counterparties?
Sure.
So this is an issue that sort of like financial institutions thinks a lot about it. It's just a question. One part of the contribution of this is that maybe perhaps it's just forcing them to sort of have into account the social benefit and not just the private benefits of disclosing information.
So on the whole, then you'd say your paper is kind of generally supportive of the program, the stress tests?
Yes, in particular of sort of like Bernanke's or in the sort of public policy arena, or Gary Gorton in the academia, of those that pointed out that the sort of freeze of markets in 2008, that it looked like I don't want to trade because I don't know, whether the other party will be able to pay me. This may be the type of situations for which this is indicated.
So when was the first stress test implemented then? And
so there are stress tests. There are similar type of tests somewhere else, and then there's also the IMF now trying to encourage more broadly, but mostly they are in the ECB and in the US, and it was kind of late in the financial, it wasn't at the very beginning of the financial crisis, so we shouldn't thinking about that fall of 2008, but in 2009 there's sort of like two waves. But even the first one, it has disclosure of this information that this is the first time that it had happened.
And I think I recall reading that Bernanke attributed kind of a calming of the financial markets
Correct.
because of the
Because
outcome.
of the
Is this-
information.
Do you share that opinion? Or?
Well, the empirical analysis is complicated because the stress test also has other features. So another feature of the stress test is that if a bank happens to be kind of vulnerable to this type of shocks, then it mandates that it has to raise capital. So that means that it's hard to know whether it was the fact that information was released or it was also the fact that it were tied to being obliged to raise capital.
Nice.
On the other hand, in Europe, the ECB conducted a stress test that didn't have the second element. It only has the informational release. Now, so maybe the comparisons between the US and the European could kind of focus where the Europeans focus on information. On the other hand, the Europeans have some other problems in their design. It was thought by most participants that they were not credible, their stress tests. Nevertheless, the papers, even under these suspicions, people find calming effects even of the stress tests in Europe. So I will say that it's hard to know. I mean, these are complicated, but my reading of the evidence is that it's supported from Bernanke's view.
Very good. Very interesting. So let's sum up, if you had to summarize kind of your research, the key messages in one or 2 points of takeaway, what would you say?
That in moment of financial crisis, there are aspects of that in which intervention that otherwise will not be kind of like a wise policy may be justified. This is also not particularly burdensome. It's mostly about revelation information. So it's a public policy that I think that is sort of reasonable from the perspective of analyzing social cost and benefit.
Very good. Thank you very much, Fernando.
Okay, thanks a lot.